everything is aligning for a late 2025 peak. The power law model captures the 16-year trend of Bitcoin. But that model only gives us average and doesn't explain anything about the deviations from that average. Quantile model, what it does is it uses a rigorous statistical approach to figure out bands around that average. For example, when someone says by the end of the year we're at 1 million, it's not impossible, but it would break everything we know about history. The core of Bitcoin's value is self-custody. If everybody's money is tied up with institutions, then okay, so one day you wake up and there's a new socialist administration is there and they decide, oh, there's too much unfairness in the economy, so let's put a 50% tax on Bitcoin. But if you do have a portion of the network outside of centralized custody, the country that does it will actually be punished.
Hello, everyone, and welcome back to the show. I'm your host, Rob Wallace, and today I am very grateful to be joined by Sina, co-founder of 21st Capital. Sina, how are you doing today?
Doing great, Rob. Thanks a lot. Pleasure to be speaking with you today.
Yes, you are one of my favorite analysts in all of Bitcoin. I first came upon your stuff back in the winter of 24 when you started posting graphs for the Bitcoin ETFs. And since then, I've seen your research just grow quite the amount over the last year and a half. And it's been really awesome to see both your online presence and just your great Bitcoin mind on display on a daily basis. So thank you for joining us today.
Thank you very much. Very kind of you.
Yes. So let's hop right in. And my first question for you is the 4-year Bitcoin cycle dead?
The hardest. Yeah. So, so far, at least timing wise, not quantity or magnitude wise, but timing wise, we are following the same timing. So, after the last halving, we had a period of a slow progress. ETFs came along. And we shot back up. Then we went ahead of what this 4-year cycle would suggest. Then we spent many, many months consolidating. We caught up. And we've been just on track as far as timing. But the quantity and percentage return has been way less than last cycle. And that's something you would expect as the asset class gets mature. The upside it gets a little bit more sluggish, takes more money to move it higher. So we do have that diminishing volatility, but it also helps on the downside. So we are seeing very shallow dips. These are like child play. Before you know it, a crash, I suppose that crash is already ended. Last cycle, we had like frequent 30% or more crashes. One tweet from Elon Musk would take us back down by $10,000-$15,000. And so we do have that difference, but at least so far the timing is similar. And if we continue towards the end of the year appreciating, which all the signs appear to suggest, we are still more or less following, we are at least rhyming with prior cycles. But moving forward, I'm not so confident. I think the cycle after that could pan out completely differently, because still this time we did have some effect from halving. Halving was still not unimportant totally. And then there was also all of the psychological effect of market expectations that creates its own self-fulfilling prophecy. But 4 years from now, halving would really be unimportant, like totally a non-event mechanically. But maybe the psychological effect will also be completely forgotten as we are getting a totally different environment with institutions and corporate accumulators and all that. So maybe the game will change, but with all that, I don't expect this concept of cycles will go away. So we'll have different timing, but we still have cycles of euphoria, over allocation, and then milder crashes, shorter bear markets. We will still have that.
And if you look at the power law, it shows us that really we should be going into this euphoric peak within the next couple of months, right? They're calling for an October, November, December euphoria. Does that feel right to you if you don't look at the models per se, but just from your gut instincts when it comes to reading the headlines and seeing the price action on a daily basis?
One quick point is power law itself doesn't really have a cycle timing aspect. So that cycle timing is an extra layer you have to bring in from elsewhere. Um, but uh, it does seem to me that everything is aligning for a late 2025 peak. It could be a like very substantial peak, or it could be a little bit more subdued. But the way things are happening, the way gold is behaving, the way stocks are behaving, and with everything with the fiscal and monetary paths of the United States and the rest of the world, it all seems like we are expanding liquidity. And this will at least go on for another 12 months. So during this time span, I do expect Bitcoin to do well and keep growing despite some volatility, some ups and downs. Maybe we will have some pauses to liquidity because of TGA refill or other things. But overall, seems like towards the end of the year, Bitcoin should be doing much better and should keep growing. And if that happens, we are again exactly where prior cycles would suggest. If you map what happened in cycle 1, 2, 3, 4, and like see how many days it took to reach the peak, and then work it from this recent halving, you pretty much get to the same timing, like November, October, December. Um, because some cycles had double tops, but the second top falls in November period. And if we keep going up, we're exactly rhyming with that pattern. And that said, another interesting aspect would be if we actually do, say, go from 116 to, for example, 200K by the end of the year, that would be too fast for real money to catch up in my book. So, and we know when Bitcoin price kind of runs much faster than the longer trend, you're beginning to enter a bubble, right? So if that happens actually in that November, December, if price actually goes up that much, the conditions for a bubble deflation also appear. So then we will also potentially, at least my base case is, once we get there, we will also have a pretty substantial correction, less than last cycle, but substantial. So if in that scenario, we'll get another traditional Bitcoin cycle, just more subdued and more, less violent for the new, for the taste of the new investors. That we had to tolerate 95% crashes, but today's institutional investors, they don't have a stomach for that, and Bitcoin, I guess, is adjusting to them.
And one of the tools we have now to determine whether the market is running too fast or too hot is the Quantile model. It's something that you have contributed to the space and I think is of great assistance to anybody who's trying to judge where we are in the cycle and just how hot things are. So please tell us about the Quantile model and what went into making it.
Yeah, so we start from an understanding that a power law model captures the 16-year trend of Bitcoin pretty well. But that model only gives us average and doesn't explain anything about the deviations from that average. So you don't know how much, you always go above or below that average, but you don't know how much is too much, or there's no way to quantify that. Quantile model, what it does is it uses a rigorous statistical approach to figure out bands around that average or median, right? So, and those bands, you can adjust them. At the extreme, you can ask this model to give you one lower band and one upper band that capture the lowest 1% or the highest 1% of the data, knowing that there's always a little bit of chance that, at least even historically, price moves out of those bounds, but they are pretty extreme at the low and the high. So that can give you a beautiful channel, and then you can also adjust that to lower levels, or like to get more narrower bands. And at each band, you can measure the probability of reversal. So essentially, it gives you a risk quantification method. I can show you on a graph if we can switch there.
Yeah, it'd be great.
So here you can see that, ignore all the colors for now. That white line is our price, right? And this whole log linear pattern is capturing its long-term growth. This is what, in my opinion, this is the natural adoption of Bitcoin. You and I wake up every day, we promote Bitcoin, we talk about it, more people learn about it, and people allocate. 1% becomes 2, 2 becomes 4, and so on. So Bitcoin has its own long-term growth trajectory, right? And in the short run, price can, so let's say last cycle, right? If you follow the center line, the boundary between yellow and green, you get sort of a trend, a slope, right? But price, because of COVID, we went way below that. And then after stimulus, we went way above that. And then we corrected back down to that level. Then the bear market, all the bankruptcies, and then ETFs brought us to that level again. So Quantile Model allows us to quantify how high are we. So if you're above that average line or something like that, what is the risk score? That's how we call it. So if price is at the lower bound, risk is 1% or could even lower than that. And if price is at the highest, at this top line, the risk will be 99%. Okay. And the reason we call that risk is that kind of, you can imagine a distribution of potential prices. And if you're at the 99th percentile of that distribution, you've already covered 99% of probability. There's only a 1% chance that anything else above that will happen. So you can sufficiently cut that and say that that's like a potential top. And so the beautiful thing about this is, like, at any point in time, so we don't really predict where price will go, but wherever price goes, we can quantify how higher, how risky it is. For example, if I get closer, you could clearly see that in the bottom of the bear market, this is probably $2,000 range to 16,000. The quantile scores were very low, below 33%. So this purple region is where Bitcoin spends a third of its life. So 30% of probability or observations fall in the purple line. And that captures typically the bottom of the bear market. It's interesting that Bitcoin spends a third of its time in the terrible, depressing bear market that's crushing investor souls. Then what it does is it typically moves out of that purple into a green region. That is a transition. So in many of the cycles, that transition has been an explosion out of purple into the higher levels. And in the crashes, in the bear markets, it's also a rapid transition back down. Same here. We got a similar thing when ETFs were approved in this part in 2024. A rapid move. I think this was 30K. We were kind of consolidating around there, and ETFs pushed us to the all-time high. And then we were in the transition zone. This is traditionally the separation between bear market and bull market, and this captured another 33%. So that goes from quantile 33 to quantile 66. So another 30% of Bitcoin's time is spent in this. So these observations, if you add them all up, that covered a third of Bitcoin's time, right? So we spend a third of our time there. Once the market is ready and we are there for those explosive candles, there's enough capital, there's enough, bear market is forgotten, there's enough fundamental support, then Bitcoin, as you can see, for example, in the prior cycle, after all the COVID depression was passed, we got a stimulus, slowly the market recovered, and then over time, Bitcoin recovered. And then we moved, we had a like almost nonstop move to the all-time high, and that was close to the top of that cycle. And that's where we move out of the green region and up to the higher levels. yellow, orange, red. I've just broken that, and you can see that's another 30% of probability. So Bitcoin only spent a third of its time in this euphoric zone where everybody loves, right? That's what makes Bitcoin famous. All those volatility, people love those, massive candles and all that. But that's only 1/3 of the time. And that there's a lesson in that too, right? That makes market timing very difficult. Most of your time is in the more depressing, and then you suddenly get massive boosts. We are seeing the same pattern actually in this cycle. You see, we were playing in the bear bottom of the bear market, then big jump, long consolidation, big jump, consolidation, and correction. Another jump, small consolidation. Another jump, another. So it's kind of like Bitcoin is playing this game of lots of gains in short period of time and then a long consolidation. But what is the model used for moving forward? If we keep growing in price, matching to the long-term trend, price will increase, of course, but the quantile score or the risk score does not increase. What do I mean by that? So imagine go back to the ETF time. We were at, what was that high? I think
72. Yeah.
72. So we got to 72,000. But 72,000 is equivalent to next year 100K, and then today's 116K. Risk-wise, they are the same because time has passed, so there is a natural progression of price you expect. If you only grow in price by that much, you have more wealth, but the risk has not gone up because you've given it time for the network to grow. But if we grow faster than that, instead of going this way, your price will go to these regions. Will enter orange or red region. So that's how you can see price is growing faster than the long-term trend. And if that's the case, you keep accumulating risk, right? And there's always a chance that Bitcoin decides to completely behave differently and leave its 16-year trend and do something else. There's always a chance we have that, but unless we have a strong evidence for that, we are staying with something that has worked for 16 years, right? Now, keeping that assumption, if we suddenly go to, so by the end of the year, if we get to 134 or say 130 to 140 region, that's no additional risk region. That's kind of natural, totally natural network adoption. Anything above that makes the market hotter and hotter, which is not a bad thing. If you go to the last cycle, the market getting hotter was not a sign of top. You actually have to give it some time to completely pan out, right? So the heat and leverage is bad in the late stage, not in the early stage. Mm-hmm. So if we get into something like 150 or 200 or 300, these are different risk levels by the end of the year. And if you want to get like a medium place, Quantile 90th is at $200,000. So anything above that gets you to the more than 90% risk by the end of the year. So in my book, that would be considered a danger zone. Of course, again, you can enter danger zone and stay there for a while for wild price appreciation. That's okay, but if the long-term adoption holds, you're going to come back down the trend at some point.
I wanted to briefly interrupt today's interview to give a big shout out to our lead sponsor, Rhino Bitcoin. Rhino is the all-in-one Bitcoin super app built by Bitcoiners for Bitcoiners. Buy or sell instantly. Send sats anywhere on the Lightning Network. Withdraw straight to cold storage. Even turn sats into gift cards or link to a Casa multisig, all within one sleek interface. And Rhino is just warming up. Soon, you'll pay bills, borrow against your Bitcoin, and save for retirement, all without leaving the app. Download Rhino at rhinobitcoin.com or tap the link in the description below. Use promo code BitcoinNews and Rhino will drop you $10 of free Bitcoin into your account today. Secure your stack with Rhino Bitcoin and enjoy the rest of the video.
This is a good way to gauge your expectations and then measure at any point in time how if is the market overheated or underheated. And this has been tremendously helpful for me, for myself, and I hope this also helps people gauge expectations. And like, for example, when someone says by the end of the year we're at 1 million, you have to extend this chart, and there's no room to show that 1 million, right? So you could see how unnatural or how unexpected that would be. It's not impossible, but it would break everything we know about history.
And you just brought up an important word, natural. So when you compare the growth of Bitcoin and its adoption to natural phenomenon that you would find in nature, what similarities do you see, and has that come up in your research?
Yeah, basically, this pattern is not a random pattern that we just tried and worked. This is something that comes from network theory and growth of the networks. Generally, the networks that whose power is proportional to their size, which is like very similar to human social networks. Like you have a social network of 2 people, that's fine, but 3 people are more powerful, right? And 3 people can attract another person faster or easier than 2 people. So 3 becomes quickly 4, and 4 now becomes more powerful, becomes 5 fast. And you can imagine how that process moves. It quickly gets into 10 and 100 and 1,000. And the larger the network, the faster it can bring in new members. Uh, Turns out Bitcoin operates the same way. And if you just work out the math and kind of simulate a network that behaves like that, it gets more powerful as it grows. You get to log or a power law model. And then when you apply that to the price data, you see how beautifully it captures Bitcoin's long-term growth. So it matches what theory would suggest, because Bitcoin exactly should behave like that, because when it's a small asset, some people, some early adopters like it, but a lot of people are kind of skeptical, right? As it gets bigger, just because it has more people behind it, new people will join, and it would be easier to turn or convert the skeptics. As those skeptics join the network, like super conservative skeptics now begin to rethink, right? So that kind of that becomes it becomes easier and easier to grow the network. I remember like 5 years ago, questions we were answering in live calls and all was this is too good to be true. Government is going to ban it, you know, but that's completely changed. Today, it feels those days feel like ancient history, and people who would have not invested in this because of the fear of government and things like that, they now have the complete green light to join and join the network. Now we have the administration of the perhaps biggest economy in the world supporting Bitcoin. And that will begin to actually convert higher levels of capital, higher levels of institutions, more conservative 401ks, I don't know, retirement-related institutions, insurance, and ultimately sovereigns. They will be step-by-step converted, and this is a function of how big Bitcoin is. Actually, Bitcoin is now a little bit too small to be able to handle cross-country trade, just because liquidity is not there. But as we get there, we will begin to see pretty interesting phenomena where countries will begin settling transactions in Bitcoin. It's the dumbest thing to try to do that in gold, very expensive, but you can't do that in Bitcoin because it's still too volatile, and you can move the price if you make a huge transaction, right? So as it gets bigger, it's going to bring in a lot of those economic activity inside, and with it, sovereign treasuries and all that. So again, social networks move like this. Typically, a log chart would capture price growth very well. But it's not.
And,
But just as a last point, you also see that in physical systems, like any system that behaves in this way, where as it gets bigger, it attracts more. You can think of even some bacteria grow like that. So it's kind of a like very robust pattern that nature shows.
And when you talk about this online, it ruffles some feathers because this is the slow, methodical grind upwards, right? And I think we're seeing that more in this cycle than we have in any time in the past. A lot of time in that green transition zone where we're building that base and then go up $10,000, $15,000, build another base and repeat. But other people would come back and say, at some point, we're going to hit S curve adoption, where we then rocket up and Bitcoin goes to infinity as fiat goes to zero. Do you think that that could play out, or is that a fantasy?
I guess in a very, very long time, towards the end of fiat's life, that can certainly happen. But that also implies if fiat goes to zero, so if the base money goes to zero, that means you're having a pretty bad economic turmoil, and society's fabric is breaking, and a lot of people that have not yet adopted to Bitcoin are now in deep trouble. You have security issues, right? You have crime, um, you have riots, you have families breaking. It's not it's a very weird situation, right? And at the end of it, a new monetary system will emerge and things will settle down. But during that time, you're probably very worried about other things. You're trying to get bygones and other things like that. Um, and you probably won't really enjoy that period much. Plus, the appreciation in Bitcoin's price that comes because of collapse of fiat is probably not like much different than the appreciation in purchasing power, right? So fiat is collapsing, but that doesn't mean your Bitcoin is necessarily doing 100x. Your purchasing power is growing much more modestly. So I don't really focus on that final step where fiat collapses because I care about purchasing power of Bitcoin, and that's how your real wealth grows. And before that time, um, unless we see different evidence, Bitcoin actually likes to show diminishing volatility, the weaker explosive price action to the upside, but also much more subdued corrections. In this cycle, if anything, we are seeing a bigger step in that direction. Let's go back to the cycle 4, last cycle, right? When we got to maybe 20 or 30K, people were predicting like famous predictions where, what was it, like 150 was one of the common predictions. And then another one came with 280. And then people, as price reached 50K, people were like, oh my God, it seems to be correct. Who thought? I mean, at 10K, did you think we can get to 50K? So why not? 180, 150 is within reach. And then, like I said, new models came promising 280. From there, I remember very closely, 280 was still bearish. Like if you had a 280 price target, it was bearish and people would make fun of you. It was fun times, And 500K, and some people were predicting 1 million. Okay, so we topped at 178. What was that? No, I think
69.
68, 68, 69. Yes. So that was the problem that happened, is that people were trying to extrapolate what happened in the cycle before that and just expect the same level of return. And lots of people learned a hard lesson that as assets mature, they move less. And then we got correction, and we had to pay back for all the leverage and all the GBTC effect and all those hedge funds and so on. Then once we moved out of the last bear market to the all-time high after ETFs, we began again. I clearly remember, I think sometime last year, very popular predictions emerged 500K, and just this year apparently 1 million is in fashion. In all of those cases, I was looking at a chart like this, and I was thinking, this would be very, very unusual. And just on the chart, you have to extend that top of this chart. So something super weird has to happen. Just a natural process of regular investors, individual investors being replaced by institutions. That's kind of what's baked in, right? That's not a like totally unexpected massive event that will break the prior trend. Actually, what takes us from here to 200 to 500 to 1 million is this gradual joining of sovereigns and so on. So it's still part of the long-term path, right? It's not something that's totally out of ordinary, unless maybe aliens come in and say, hey, we like your Bitcoin and we want to put money in it. It would be very unlikely to get those super high prices. And again, another thing that this model really helps us is it allows us to see how bizarre some predictions would be, and kind of give us a more reasonable expectation of what's coming. This cycle has been pretty interesting. We are kind of stuck at the same risk score. Like, since it's been 1 year and a half that we are at around 65% risk score. You could see that on the chart again very easily, because after ETF approval, we hit this line. We went back down to the lower level. And these are not optimized for this price. Like these, you get the same levels even if you run this model on the last cycle data. So for some reason, these 30%, 60% quantiles appear to be significant. But price goes up, corrects back down, goes up, corrects back down, goes up, and we're still not adding to risk, which is actually a good thing if you think about it. So you have almost doubled 50 increased price 50% from last year, but your risk has not. So everything we've got is not the bubble, is not the excitement, it's natural adoption. So that also means your correction, your downside will be a lot more unlikely. But as the risk score goes up, I expect more violent corrections.
And last cycle, did you have this lens? Did you have a feeling when we were in the 60,000s that we were in that upper 90% plus quantile?
We didn't have this model back then, but I used other things. First thing I used it was my own feeling. Like when you went on social media, you would see everyone is in pain and panic and damage. And we also had some live calls with some of our audience because we were running an education platform back then. And you would just see everybody's in terrible shape. And generally, that would be that told me basically that we are either close to the bottom or already there. So that was one sign. Second sign, I was watching funding rate. Funding rate, if you go back and look at the average funding rate of the futures market, you would see that it goes to a terrible, like kind of a low extreme, sometime where some at around 17,000. And that was pretty unexpected. I was watching that, and I said it's very likely that it's a bottom here. The third sign was that I myself was beginning to worry. So up until 20K, I was feeling nothing. Below 20K, I was like, okay, this thing actually broke history, because we had never went back down to a number lower than prior cycle top. So we did it, and I was like, okay, maybe things have broken. Maybe we will go back down to much lower numbers. But then I told myself, okay, if you are, I typically I'm more on the stoic side. So I went into this knowing that, expecting huge volatility and all that. But then I thought, okay, even if I'm worried, chances are everybody else is, right? So for all these reasons, I just kept buying and buying with very high confidence, right? I overall I had a really good feeling in that period, just accumulating, and I'm proud of my bank account being always at zero. I would just shovel everything all the fiat back to Bitcoin. And then once the price rose, uh, somewhere above 30K, it was very clear that the bear market is over. And uh, BlackRock news, gave us 1 full year to accumulate, and most of the gains came late. So from that point on, the game changed. ETFs came along, and then I decided to be more active on social media and put out more analyses. And because I realized a lot of people actually don't realize how much of a huge difference this is, right? This whole ETF thing was completely changing the game, and then that ended up leading to you know the institutions coming in, and then administration coming out in support, and then from there we were just getting good news after good news.
Yeah, it's been a wild ride these last 4 years or so. I mean, one clear memory that I have is looking at my block clock at the bottom of that bear market and seeing around 6,000 sats per dollar, and now it's 850 sats per dollar. So, boy, have times changed. Absolutely. But Bitcoin is just one part of a larger global economy. And you have been taking a contrarian stance. You have many people online, especially those who are fans of Trump and his presidency, that say this is the golden era, right? The tariffs are working. We are in this golden age of American growth and reshoring, bringing manufacturing back. But you have thrown up some red flags. You say tariffs are not that good. This 3% GDP number from Q2 is pretty illusionary, and the jobs numbers have been just outright scary. So where is the American economy right now, and can Bitcoin take that run up to 200K in the face of a recession in the second half of this year?
Yeah, I'm glad you brought that up, because it's kind of forgotten how the environment was in January. In January, February, when Trump debuted the tariff plan, there was two big ideas. One was the traditional economics thinking that tariffs are not helpful, and then people would use that to then say that, okay, a recession is beginning imminently, and Trump is going to crash everything, and the market is dead, and so on. Then there was another newer, smaller group, perhaps outsized or outrepresented and overrepresented on social media, that were saying these are actually going to be fantastic. So Bitcoin is going to run from here, and market's going to run from here, and everything's great. Um, I had a third view, which was kind of a combination of both. So I was expecting tariffs to crash the economy and the markets with it, but not to the extent that it leads to recession. Why? Because mechanically, tariffs do slow down trade, and when that happens, everybody earns less money, uh, and you begin charging somebody for economic activity, they're going to do less of that. So less economic activity means less purchasing, so your suppliers are going to be hurting. Also less selling, there would be smaller availability of products. And at the same time, maybe you also don't have enough, that much need for hiring, so lower employment. And all the negative things you expect, economic slowdown, would come from throwing tariffs in the mix. However, I also recognize the strategic issues there, right? So there are markets where you just can't allow foreign adversaries to come and capture and corner the market because they are stimulating hard, and sometimes you have to intervene, right? So that I understand for certain products and certain markets, pretty strategic ones, military items, maybe some portions of the healthcare supply chain, which actually we are not doing much to improve. During COVID, we realized most of our pharmaceuticals come from China. That's a huge strategic risk. We are buying a lot of rare earth from China, even though we could actually dig them out of the ground. We have there are many minerals that we do have mines for, we do have resources, but just for cost reasons, we rely on China, and they do a very efficient job at that. And over time, we grow so dependent that it becomes a risk, right? So that's an issue. I think that should be addressed, but we can discuss whether tariffs are really good or instead you should actually directly support some, for example, in that case, mining operations, like give him direct stimulus as opposed to stopping the inflow. So that's a different question. But the on the short effect is a loss of economic activity. So even if you have a strategic, legitimate reason to put on tariffs, the cost is it's going to slow down your economy. Now, so that was my thinking. But then at the same time, I added this layer of understanding of Trump administration. Like he wants to appear very powerful and the strong man that restructures the world, but he's also a market and businessman, right? So my expectation was the moment he realizes that all these tariffs are cracking the markets, he will back off. And that pretty much exactly happened when the bond market started crying hard. He added all those pauses and suddenly went from, okay, I'm not going to yield at all to, okay, we're going to be lenient. We're going to make deals at 30 days of pause and then 90 days of pause. And the pause allowed the markets and lots of companies to accumulate lots of inventories and deal with it in the proper manner, right? Previously, it was very sudden and much more troublesome. So it was very clear that it's gonna, throw a huge wrench in the economy. And so the first prediction that it's going to be great really didn't pan out. But also the second prediction, which some people maybe even with like political views brought, that also didn't pan out. We had a massive V-shaped recovery because Trump clearly showed that he has also an eye on the economy and doesn't really want all this to end in a recession. So he wants to get some concessions, but at the end of the day, they will try to do other things to support the economy, or at least if tariffs, which as I suspect, will get us to the brink, he will go all the way to the brink, but not further. Now, so that combination of thinking is a long explanation, but all that came into this V-shaped view that we put out and pretty much panned out. And like if you use that opportunity to accumulate, I think you were able to buy Bitcoin at 75, and it's a really big appreciation so far. But then once we got that rapid recovery, we flipped a little bit less bullish because we in our playbook we needed Fed to also support the economy, and we needed some further support from Treasury. We recovered without all those. So that told me that we are maybe running a little bit ahead of our plan, and that's a few months back. So and since then we've had a kind of a consolidation period, and we are waiting for the next leg up, pretty much as we expected. But the next leg up is getting harder to make sense of, right? Because we will be getting cuts pretty surely in the next meeting, unless we get a completely different data. But it is also possible that before that happens, we get so much bad data that the markets begin thinking about a recession. So, but the path moving forward is very clear. We are going to have this 15% baseline tariff everywhere. And it would be, little deals here and there, but overall, you make everything more expensive by 15%. Again, that's another misunderstanding. A lot of people are gonna say, "Oh, this is gonna lead to massive inflation." No, actually, for everything that I explained, it's not going to be very likely not going to be a persistent inflation. It's going to give a shock to prices, but that shock is going to cause consumer to pull back, right? When they pay more for something, they're going to pay less for something else. So overall, when you look at the overall data, you're going to get subdued inflation, maybe a few months of higher ratings, but then that's going to quickly replace with economic slowdown and the trouble in the labor market and all that, which is the stuff we've been saying, earlier this year. And pretty much right now, I think the data reflects that sentiment. Now, moving forward, um, if we get another really bad employment report confirming that there is a downward trend in the health of the labor market, I think a 25 basis cut is for sure, and maybe a 50 basis point is on the table. Plus, there's all sorts of these crazy things happening at the Fed, right? Um, Governor Kugler resigned, leaving an opening for a new Trump nominee, which long awaited direct Trump influence in the group. And then Powell is going away. Powell is facing more dissent from two governors, Bowman and Waller. So the third one is going to be added by Trump. So it's kind of like this battle between the Powell and company, their team. They are hawks. Arguably, they're going against the data. And then there is this little growing dissenting minority that's being acting as a shadow resistance.
If you were in Powell's shoes, would you have cut already? Do you think he has been political and been stubborn because he doesn't want to give this to Trump? Or is he looking at the markets and seeing that we're just a few percentage points off of all-time highs in the S&P, in the NASDAQ, Bitcoin, gold, everything's at all-time highs. Why would you cut in that situation?
Yeah, this is I feel like they are playing a game with the public. And I tell you why. So they typically say we have this double mandate, maximum employment, whatever that is, right? Maximum employment and stable prices, right? So they have to worry about inflation and labor market. But when we were in COVID times, there was political appetite for stimulus. And even though inflation was high, they didn't care. They kept stimulating. And then later they admit that this was too much. And God knows, 5 years later, we're still paying for that. Lots of people, young people now can't afford houses just because the Fed did that. And their reaction function was too dovish and too much focused on the labor market. Now, what they say is we anticipate a potential and theoretical effect to inflation. And even though labor market is not particularly strong, we're not cutting anything and we keep rates at a very high level. So this doesn't match what they did in the last time. If you didn't know their history, you could have said, "Oh, these guys are probably, they have a point. There is a chance that inflation is going to be higher for a couple readings at least because of tariffs, and so let's wait for that and then keep cutting." But two things: we are at historically very high restrictive levels. They only cut last year, which also matches the election cycle. They're not cutting now when even data is showing weakness. Inflation is not happening. Inflation, you should have actually, if some of the worries were right, you should have seen much stronger inflation by now. We do see a slight elevation, but we're still stuck at the stable 2+ something percent, like 2.5%, which has been there for a while, for at least a year and a half. And it's really not rising meaningfully. Instead, employment is not so good. There's ample evidence showing that housing market is in pain, automobile market is beginning to have trouble, and no one can economically borrow money. Given all this, they are resisting cuts, and that sounds a little bit out of their, deviating from their historical pattern. They traditionally have been a lot more willing to cut rates and bring them back down to normal levels when your economy is growing only at 1.4% in the first half, and your federal funds rate are at 4.5% or around that. That really doesn't make sense. Your rate should be much lower than that. But they're not. So then we have to think, okay, could it be because of political reasons? I don't know, but everything I see kind of sounds like it. Powell could have this idea that I want to be Volcker and I want to break the back of inflation and all that. Maybe that's the reason. maybe he's like, he knows he has no place in the next round, so he's out already. It's very clear. So maybe he wants to at least cement some character and some legacy as somebody who resisted political pressure, which is kind of another lie of independence. I don't know. And it could also even be a direct attempt to hurt the administration. But certainly what they're doing right now doesn't make sense. And the recent dissent from at least two governors, which was historic, like I think we haven't had two people rejecting the overall consensus for many, many decades. And that also reflects this internal division.
So now taking off our econ hats and putting back on our Bitcoiner hats, you've been here for over half a decade now. You've seen the culture in its different phases, and you at 21st Capital, you guys are focusing on self-custody, making sure that you take care of your Bitcoin as a tool for sovereignty. Have we lost that mission right now? Do you still see that flame being carried in certain places? How would you describe the general zeitgeist of Bitcoin and Bitcoiners right now?
Yeah, so basically we focused a lot of our energy on promoting self-custody because we thought Bitcoin's the core of Bitcoin's value is self-custody. Like if that's gone, how are we different than just a better performing gold, right? If everything is in centralized custody, probably we're not getting we're squandering the potential. If people actually do self custody, then that's where you can expect a free transaction, free parts of the economy to thrive. But if everybody's money is tied up with institutions, then okay, so one day you wake up and there's a new socialist administration is there, and they decide, oh, there's too much unfairness in the economy, so let's look at the parts of the market that are purely speculation in their view, and okay, Bitcoin is a good candidate, boiling the ocean, so let's put a 50% tax on Bitcoin, so you can't pull your money out of ETFs without losing a substantial part of it. Very reasonable, very expected. But if you do have a portion of the network outside of centralized custody, this action will actually strengthen the value, or motivate people to pull their money out as much as they can, or when the news or fear begins, they will pull all the money out, and the country that does it will actually be punished. But this only works if there is a kind of reasonable amount of Bitcoin held in self-custody, right? Otherwise, you're going to have significant trouble. Now, the problem we see in the space right now is that is, at least on the surface, is being replaced by excitement over institutional investments. Institutions are great. They make everyone else rich. They raise the price, and we love that. But they also come with risk, right? And I think the ideal case I would have wanted to see is Bitcoiners, especially older, the ones that are really stay true to the core mission. They would be cheering for institutions exactly at the same time that they promote self-custody, and they always keep that caveat. Hey, this is fantastic that BlackRock is coming in, but we have to make sure we give enough attention and energy to self-custody. Kind of like Bitwise is doing, right? They had their own ETF, but at the same time, they were supporting development as well. But what I'm seeing that, which is a little bit disappointing, is a lot of the OGs and people who have been very critical of the Fed and the fiat money and printing and all that. They are now completely switching to becoming the corporate treasury promoters. That's a little bit odd. And then I wonder, if we keep doing this for another 5-10 years, how would Bitcoin look like at that point? Do we have still enough energy and motivation among free open source developers to carry that mission and get us to a place where we have really user-friendly popular money outside of governments, or this trend would actually wash the brain of the community to say that, okay, all we want is a store of value and price appreciation for now, and then let's worry about other things later. And by the time, when most of the coins are stuck in some sort of TradFi wrapper, it will already be too late to think about a medium of exchange properties, right? I don't see enough excitement in people promoting P2P transactions. Much more excitement is seen in TradFi. I'd like to think that's a phase, like once potential leverage accumulation and maybe less than prudent actions show some of the risk. Maybe people will come back to realizing the value of self-custody, but I do worry about that a little bit. It's not an imminent issue, but if we keep doing the wrong things for 5-10 years, maybe it would be much harder to fix and get back to our core mission. But as far as what we see in self-custody, we do see, even with all the ETF ease, we do see, and this gives us a lot of joy to see there's a base of investors that realize still they can easily buy the ETF, but they also choose to do self-custody, at least what we see with our clients. That's pretty good, but still we do see most of the marginal money is now going to TradFi vehicles. So that's a concern, and I think it's not late for Bitcoiners to try to promote self-custody more. And you can be someone that likes an ETF investment. It has its own advantages. It's government protected, so a lot of people need that. But at the same time, that's kind of like, it has to be promoted as a temporary solution, right? Not as a replacement for self-custody. I think we should do that. We should move in that direction. And the moment you see a problem happens, again, a socialist government, it's very easy to imagine the next government would be an antithesis to Trump, and they would take completely different view of Bitcoin. At that moment, you realize you shouldn't have trusted the centralized custody much, right? So it's kind of like one of those things where it's not a problem, and then suddenly it is a problem. It's better for the community to be prepared for that.
Yeah, I 100% agree with where you're at. A lot of Bitcoiners came in during 2020. I mean, it was during COVID, right? It was during this massive printing, this government overreach, and there was an ethos of let's protect ourselves, let's figure out a way to get outside of this system that seems to be clamping down on us. Whereas now, the class of 2025, people will come in. I mean, I'm seeing posts of people saying, I don't need sovereignty, I need performance. That's why I'm 100% in MSTR, 0% Bitcoin. And I mean, that just blows my mind as a 2020 Bitcoiner, when we were like, not your keys, not your coins, have fun staying poor, and become part of the revolution, right?
Yeah, and you know what it brings to my mind is when people said, like, the Shiba Inu, I don't want Bitcoin, I want all Shiba Inu because it gives me 10x return. Okay, generally the pattern, this really feels like the way this will end is you will do that too much. So the thing that was really outperforming stops outperforming, and it has to correct back down. And if you FOMO at the highs, it's going to burn you a lot, and then you go back to the core. That's why I'm thinking, like, over time, it's very difficult to outperform Bitcoin, because even if you want, you can expand the supply. But if in any of these things, for example, a stock, MSTR, or other ones, they have huge incentives to dilute, right? So they can outperform, certainly, and they have. But just this year, we've seen, after this tremendous outperformance, they decided to dilute the hell out of the stock, and it hasn't gone anywhere since then. Like, it correct back down from 600 to 400, and at around 550 or 600, that was the maximum promotion. And I was just watching lots of these options speculation courses or classes or information or discussions were there, and I can imagining at the top you put on leverage. Now we are like 50% lower, and you have pretty much lost 80-70% of that bit. So that's kind of the same pattern. We've seen it over and over again. In every cycle, you see something pops up that is promoted as the better Bitcoin, and it always has a story. Sometimes it's a replacement for Bitcoin. Sometimes it's like stacks. It's a new coin on top of Bitcoin. And sometimes it is an adjacent vehicle that accumulates Bitcoin. Remember last cycle, people were cheering for Luna, right? Luna UST. And some people were, half of the community were very correctly saying this is still a, unstable business model. But the other half was like, who cares? They're buying Bitcoin, right? So there was reason to be happy about it. But whenever there are, when there is games like this and fiat games being played around Bitcoin, you have to keep that healthy skepticism to be safe. That's certainly what kept me from FOMOing into MSTR earlier last year. So
Yeah, and that's the beauty of capitalism and markets, right? That the froth will burn off, and you'll be left once again with the diehard community who is about sovereignty, self-custody, and carrying on that original mission of Bitcoin, which is being able to be your own bank, be in control of your sovereignty, your future, and your wealth. So, Sina, thank you so much for joining us today. If people want to find out more about 21st Capital, where should they go?
So you can visit 21stcapital.com. We offer primarily two services. One is self-custody, which is a multi-layer multi-sig with natural and embedded inheritance that would be protected by on-chain security of Bitcoin. So that's one product. And then second, we also offer market research. You can, there are subscriptions available. We analyze market every week in the form of writing and videos and all sorts of things. You can check that out as well. And you can also find me on Twitter at Sina_21st. Happy to connect, happy to chat, and thanks a lot for having me today.
Absolutely. I do think that you are one of the beacons of truth and a humble approach towards Bitcoin and its path into the future. So thanks again, and we'll be in touch.